Uh, okay, so hi everyone. This is Finance Ministry Real Estate. It's a pleasure to have Bill Ham here today. Join us, and so he's an expert on creative financing. Creative cash is the topic that he's going to discuss today. He's also Chief Operating Officer of Broadwell Property Group, and he has had his career in multifamily real estate with excuse me. And so he has over 20 years of experience in the field, great record of identifying, acquiring, operating, and divesting of large footprint multifamily housing. He's passionate about educating people, and he's also a coach and mentor for the future titans of multifamily. So with that, we're gonna do today a 45 minutes lecture and 15 minutes Q&A at the end. So if you guys have any questions during the talk, you can just put your questions on the chat, and then we're gonna open up the floor at the end. So with that, I'm gonna pass it on to Bill. And yeah, it's really a pleasure to have you. Thank you,
Thanks,
Bill.
Devin. I appreciate you having me. Definitely. I see several people here I know, and maybe we'll have some more jump in. Yeah, thanks for having me. As you said, yeah, I've been in real estate about 16 years, a little over 16 years. Started off with a duplex. I built my way up to over 1,000 units. I've done just about every kind of property you can imagine, and specialize in multifamily. And I have built a management company as well. Now I'm currently the chief operating officer at Broadwell Property Group here in Atlanta. So I'm in Atlanta, Georgia. And it's been an interesting business. And recently I released a book called Creative Cash. And it's a book on creative financing, the major topics being master lease options and seller financing. We'll kind of talk about some of that tonight. The reason that I wrote the book is how I want to start this presentation. So what I want to do is I'm going to share my screen with you real quick, and then I'll show you kind of a quick rundown. Let's see, let me get the slideshow actually going here. There we go. Stefan, are you seeing the screen? Does that look right to you?
Not yet, actually. Not yet.
Not looking at the slideshow? Let me see. I'm sharing the wrong screen. Hold on.
You should be able to.
All right, hold on. Let me let's see. Why is it not sharing? Oh, it's because I didn't actually hit the share button. How's that?
That's perfect.
That's perfect. Okay, there we go. All right. So I started off in business in 2005. So been out here for a little while. And one of the things that I've come to realize through my time in business is that markets cycle. They go up and down. All markets cycle. Real estate, stocks, everything goes through these cycles. And what I realized was that the majority of my mistakes that I made in multifamily came from not understanding the market cycle. I mean, getting in at the wrong time, investing, making the wrong decisions, things of that nature. So back when I got started in 2005, I was in Macon, Georgia, which is a pretty tough city if you look it up. We were the 8th most impoverished city in America back in the last heavy recession. So pretty tough area, pretty tough city. And what I realized was that I had no credibility, I had no experience, and I had quit my job. So those were not a great combination of things to get started with. And I had to get out and figure out real estate on my own. Well, what I realized was that solving problems was the fastest way to create value and the fastest way to get started in the real estate business, whether it's single family, multifamily, storage, whatever the case. The fastest way to make money is solve problems. So I realized that problems are cyclical. People have problems when the market is not great, and then people tend not to have so many problems when the market is very good. Well, over the last 5, 6, 7 years, the market's been pretty good. We know now over the last 2 or 3 years, the market has been very heated. And as of today, the market can be even quite overpriced in some scenarios. But what I want everybody to understand about creative financing is it's very specific to market cycles. And we have not seen a lot of creative financing over the last 3, 4, 5 years because people have had the ability to just sell. So they had a problem, they can just haul off, sell the property to the market. So what I have here on the screen is just a quick example of market cycles. I did not create these. These are just the normal business cycles. You can find this anywhere on the internet. When we're coming out of a recession, we're in the expansion cycle, as you can see here. So I would put this graph starting back in, let's just call it 2008, the last major downturn. So for the last 6, 7 years, 8 years, we've been in this expansion cycle. We reach a peak cycle, and then we go into a contraction cycle, trough, and then the cycle starts itself again. Now, this is a generalized graphic of market cycles. What you have to understand is it doesn't really look like this. This is just sort of an exaggerated drawing. What market cycles look like typically is a little more like this. You're going through this expansion period, everything's up, up, up. And then you go into a peak period, and it's not like we saw in the last slide where it's just at the top and then all of a sudden it drops sharply to the other side. It's not how it works.
Oh, okay.
Typically, you go into a leveling off cycle here. That's your peak cycle. And then we go through the recession trough where it levels off again, and then expansion.
The house you would want, like a condo.
Hey, Dane Black, if you can mute your mic, I appreciate it.
I blame them.
So, all right. So anyway, going forward. So this is the expansion cycle here. It's where we've come out of. I think we're in the peak cycle right now.
Hey, but it may be for him, So, okay, cool.
Yeah, sorry. Let me
Diane Black.
Okay, you're welcome. All right, you have a good day. All right, bye-bye.
Okay, let me try to, I can mute everyone.
All right, if you can do that, go ahead.
Yeah, and then.
All right, so while you're working on that, there we go. All right, cool. So as this is where we're at right now. I believe we're in a peak cycle here, and then we will go back into a recession cycle and trough cycle. Creative financing becomes most readily available in the peak and recession cycles, not in an expansion cycle. Why? Well, because as the market is expanding and the prices are going up and everything's good and happy, if a seller has a problem, a distressed asset, some kind of issue, they probably just put it on the market and sell it. No problem. It's when we level off and then we go into a peak cycle or a recession cycle that debt stops funding and stops being so readily available for distressed assets. That's when creative financing kicks in, because the lenders start pulling away from these assets that are harder to finance. Sellers then have problems. They look to sell the property. You really can't go over to the bank and get a loan. How do we solve the problem? Creative financing. And so that's why I'm kind of showing you a quick rundown of the market cycles and why we go in and out of times when this is more or less relevant to use. All right, so the next thing I want to show you is what it really kind of looks like typically when we're talking prices. All right, normally we go through an expansion cycle and then we level off, and that's that peak. And so it's not really a decline at all when we're talking about prices, because if we really look at the prices, especially in multifamily, over the last 20, 30 years, did they ever come down? Nah, not really. No, they went up, they cooled off for a while, and then they went up again. So this is really what a market cycle looks like typically. You have that expansion, prices are going up like they are now. The returns start to compete with everything else in the world. When the returns in multifamily start to be comparable to what we can get in the stock market in other markets, that becomes a little less attractive. I mean, you're dealing with a mortgage, an asset, tenants, management, and you can make the same amount of money just sitting in the stock market. Why would you come over here to multifamily and get into a tangible asset? Well, that's where we see the market cycle, and the returns level off in the peak, and then we go into an expansion. I am predicting, and I'm going to show you something coming forward. I'm predicting a market cycle that we've never seen before in American history. Right. And that is about to be a split in our world of real estate. So what you have to understand is that in real estate, we have 4 categories: A, B, C, and D. A being your brand new, marquee type property, very new construction, super high rents, white collar tenants. B's being a little bit older, maybe 10 to 20 years old. C's being your affordable housing. On the high end, you've got blue collar workers, and the low end, maybe Section 8. And then we have D's, which are our low end war zone, tough type assets. What I am predicting going forward is that we are going to see a split in this assets. Before, A's and B's and C's and D's all sort of went up together, and they all sort of went down together. They all went up and they all followed these market cycles together. What I am predicting over the next 10 years, starting in about a year to 2 or 3 years going forward, is that we are going to see a split where the A's and the B's go up in value and the C's and D's crash in value. And let me show you, that's going to look something like that. That's what I think, as opposed to the market going up, peak leveling off, and then, all going up again. I believe the A's and the B's, as you see here, will continue to rise in value. It is the C's and the D's that you are going to see split and go down in value. Why? Age of building. We have not had the majority of our affordable housing in America reach this age yet. If you look at construction, most of our larger apartment complexes were all built around 1960 to 1975, roughly. It was a post-baby boomer era. They started building apartments with pine frame construction, wood instead of brick, and things of this nature. It became more affordable. That's where we saw all these apartment complexes get built. The problem today, they're old. The plumbing is old. The roofs are old. The electric is old. The inside of these buildings is old. Not a problem. Money solves everything. The purchase price is the problem. And that's why we have a problem today in the C and the D space, is that the difference between the returns between an A and a B and a C and D has become very narrow. We talk about cap rate or capitalization rate. And the cap rate between the A's and the B's and the C's and the D's has narrowed to a very narrow gap, and it doesn't make sense. It's kind of like saying an old car and in a brand new car are almost the same price. That doesn't make any sense. Well, that's what we're seeing in multifamily. And the problem that's never been a problem before is these properties are overpriced and they're getting old. And when you stop to look at the interior, the plumbing, the electrical, the infrastructure, and you say, okay, if I buy this property, let's just say for $50,000 an apartment, and then I have to come in and spend $25,000 an apartment in all the upgrades and the repairs, and I'm all in at $75,000, is the property worth more than that? And my estimation is going to say no. You're going to be upside down. So you're going to go in, you're going to buy the property, you're going to have to do all these repairs and maintenance, and the property's not even going to be worth what you have in it. That's where we're going to see a heavy decline in the C and D assets, because the only way that we can keep the value is if the rent continues to grow exponentially. Well, we have to have job growth and employment growth at the same rate as rent growth to continue to have rent growth. Yes, we're seeing a lot of rent growth in America right now. We are only seeing the job economy start to catch back up to it. And so when you take all that and then you look at the building getting a lot older and you having to do a lot of repairs and maintenance on the property, it's just overpriced. So how do we solve that problem? How are sellers going to solve this problem? Creative financing. That's what's going to happen. Yes, Stefano.
If I may interject, just a question.
Please, yeah, jump in.
The split in A and B versus C and D that you are foreseeing. So that's something that you see only in the commercial space, or is it also in would you say in residential like 1 to 4 unit housing as well?
Yes, I am seeing it in all aspects of older buildings. So it can be houses and it can be all the way up to a condo in Miami. That condo that collapsed in Miami is an extreme example. It's an outlier event. I don't believe that's going to occur very often. That's what happens when buildings are not maintained and repaired. They can have very physical reactions. And yeah, I do see this in single family houses. It's a little bit easier to deal with in single family because you're not paying as much money, but the concept is the same. If you're looking at buying a house and the repairs that need to go into the house exceed the value of the house, you might as well tear it down. When it's too expensive to fix up, what's the price? What's the value? See, there's where people are going to be in trouble, and they're not going to be able to sell because they're going to owe too much on that property. And so they're going to look around and they're going to say, I have a problem. How do I solve my problem? I'll sell the property. and you come along as a buyer and you look at the property and you go, gosh, Mr. or Miss Seller, I sure would like to buy your property. Sure is a lot of work that needs to be done. Not a problem. I'll just lower the price. Here's my new offer. They owe more than that because they bought back here in this peak cycle. That's where we're going to see some very interesting opportunities coming up. And I'm going to stop sharing because we don't need this anymore. But that's where we're going to see some very, very interesting opportunities coming up over the next, I'm predicting 1 to 3 or 4 years, where we are going to see a lot of opportunity for creative financing. So my general point is not that it is a mistake to buy older buildings. I'm not saying that. I'm saying it is a mistake to overpay for older buildings because the infrastructure may be a surprise to you and may cause you to have a big capital event that you weren't planning on, which means no more cash flow. And that's what I'm kind of looking at in some of these older buildings, right?
So what sorry to interrupt again, just in terms of, so what you're suggesting, for instance, in the commercial space, so what you're suggesting is like there is the spread between the cap rate spread, for example, between the A, B, and the C and D is too narrow. So that's kind of what you're seeing historically, like, is it like where has it been in the past versus now? If you have like certain numbers on that, I'm not sure.
Yeah, I don't have a slide on it. Yeah, cap rates have been steadily compressing. If you look at cap rate spread for the last 20 some odd years, you see the chart and cap rates compress until they go through 08. And then they decompress, not back to where they were, but they decompress some, and then they compress again. So if we look at the last 20 to 30 year window, cap rates have been declining. Okay, so are we looking at a market shift or a paradigm shift? If cap rates go to 0, we don't cash flow. So are we saying, let me back this whole conversation up, and I've asked this question a lot. Does anyone, you don't have to answer this out loud, but anybody on the call here own any stocks? Stefan, Nelson, anybody, you guys own some stocks? Most people own some stocks, and they say, yeah, I own a few stocks. And I say, okay, and I say, okay, let me tell you, let me ask you a question. Do your stocks pay a dividend? Do you get a monthly check from your stocks? Some do. The majority of stocks that people own typically do not pay a dividend. And I say, okay, so you own some stocks and they don't pay a dividend. And they say, right. And I say, okay, let me ask you this. Have your stocks gone up in value over the last year? Everybody said, oh, yeah, my stocks went way up in value. And I said, but they're not paying a dividend. And they say, no. Why'd the stock go up in value then? I mean, per what metric? There's no cash flow. The stock's not producing a dividend. Oh, the company did much better. That's always everybody's answer. See, the company's doing much better and their sales are great. The company's great. Cool. So now they're making distributions. They're giving you a dividend now, right? No, they're not actually sending out a dividend. What the hell did the stock go up in value for? No good reason is the answer. So is that how multifamily is about to be traded? No cash flow? Hey, did your property go up in value? Yeah. Did it cash flow? No. Why did it go up in value? I don't know, but it just did. That's what we are saying. If we are saying cap rates are going to continue to decompress or continue to compress, if cap rates continue on the trend that they've been on for the last 20 or 30 years, multifamily will be traded something like a stock just for the hell of it. I don't see that happening. I don't see America or the world in general being interested in owning multifamily that does not cash flow just for the sake of getting a tax write-off. I don't think that's going to happen personally. I don't see everybody going out and buying these things just because they want a tax discount. I think multifamily is ultimately going to need to cash flow. But if we continue with cap rates compressing, that's what we're saying. So are we looking at a market shift or a paradigm shift? And the paradigm shift meaning we're good with multifamily not ever cash flowing again. I don't think so, which says to me, there's going to be a market shift. It's going to change. And what I think we're going to see is a long period of that flattening out, where we just don't see a lot of trades. We don't see a lot of transactions. Why? Because the returns got so low. You could just go do that in the stock market. I mean, right now, if multifamily is producing 5, 6, 7%, so what? I can do that. I can do that by 401k. I don't need to go get a mortgage to do 5 or 6%. I don't think that'll last. I think it's right now because it's the hot topic and it's trendy, but I don't think that's going to last. And I think the people that have paid too much recently, when they realize that their plumbing's breaking and they're in trouble, they're going to look around and going to say, how do I get out of this deal? You're not going to be able to buy it because the bank is going to say, hey, Stefan, that property's awful old. We'll give you a mortgage. You just need to put a lot of money in escrow to go do those repairs, and it kills your numbers. That's where we're going to see that market shift. And yes, over the last 30 years, cap rates have been compressing. If they keep compressing, then we're looking at a completely different world where we no longer use cash flow to value real estate. I don't think that's going to happen. Yeah, go ahead.
Just to interject, I think there's if you take like cash flow in real estate, like it's a function of cap rates, it's a function of interest rates as well, and then what leverage you can get, right? So it's those things. So it's sort of a levered cap rates to interest rate spread. That's what it is. But then interest rates have been dropping pretty much since 1980 till now, like over 40 years. So that has kind of worked out okay for real estate in that sense. I guess what you're suggesting is if we have, even if interest rates go to zero, let's say, or close to zero, in theory, which is not not what people expect now, but interest rates are also super hard to predict. Now, if you look at interest rates going close to zero and you have a cap rate that is actually also there, and that's a very interesting comment that you made on actually potentially trading like no dividend stocks, which is it's an interesting thing to kind of to think of, right? Now it's kind of hard to imagine, but
I agree.
Right, yeah. But I think in a way, like if cap rates are even at 3%, just to add to your point, but interest rates are close to zero, that could be working out healthy for multifamily because it's still a pretty healthy spread. It's just that it's more like where is the spread going to go? I think that's
right
what you're heading at, and there has been some compression there in some periods, etc.
Correct. Yeah. If interest rates remain low or go towards zero, we will have more of a reprieve from this. If interest rates go up even a few basis points, I think it's going to go off like a hand grenade, and it's going to blow the CD market apart, because you're going to have a accumulation of a bunch of negative events hit all at one time. Age of asset, interest rates rising, politics. And that's the third one. That's what concerns me the most about the C&D properties, especially now, keeping this current. Look at the property that collapsed in Miami. Now look at the regulation that may come after that. Everybody ran out and they immediately went through their building, and they went through their building with a fine-tooth comb. Code enforcement's crawling the city. Everybody's hyper paranoid about the condition of their building now. They even abandoned another building, evacuated another building because there were some cracks in it. That's what concerns me, is that the government tends to protect less affluent individuals. And this is not a political comment. I'm not making left or right statement here. I'm just saying it seems to me that the government tends to put regulation in place towards the more less affluent individual. They care less about rich people. They care more about poor people in their protective legislation. That is why we see rent control in New York. That is why we see the rent control in California. And we have landlord-friendly and tenant-friendly states. My concern is that the government is going to be the only solution to turning the C&D market around. What I believe the government is going to do is that when these buildings get as old as they are, they get a lot older, and we don't want to go in there and fix them up and do it, then we're going to have a tremendous opportunity. The government will they've already done it, but the government will step in and heavily subsidize renovating C&D properties. That's when it's time to go back. All I'm saying today is just don't buy older buildings at low cap rates. That's a mistake. There's nothing wrong with an older building as long as you pay the right price.
Yeah, exactly. That's your point. It's just not to overpay for not to be on the wrong side of like the spread between B and CD.
You're going to catch a falling knife. And in this case, I'm predicting you're going to catch a falling grenade with no pin in it. And that's why I'm saying flight to quality, or if you are going to purchase older buildings, creative financing. That's the answer. When we can share some of the risk with the seller, I'm all over that. But if you're telling me right now, as a seller of real estate, I've got to go get a mortgage, and I've got to reward you with the huge purchase price and a bunch of profit because you ran your property into the ground and you didn't operate it and it's old and the tenants aren't paying the rent, but I need to reward you with a bunch of money. I need to go get a mortgage that if this property doesn't perform, I'm going to go into foreclosure and maybe have my career damaged so that I can pay you a bunch of money. Yeah, I don't think so. It's not happening. That's ludicrous business. You don't ever want to do that. And that's why I'm saying the low cap rates on the affordable housing market, on the older buildings, is a crossroads of problems. Age, low cap rate, low interest rate. As long as they stay low, you'll be all right. They go up you're only compounding the issue that I'm pointing out here about these older buildings. And so that's where I kind of really teach, a lot of seller financing and creative financing and things of that nature, because I believe it is going to be the ultimate solution to unraveling the problem. Nelson, I see you raising your hand.
Yeah. So a quick question and a quick plug. First of all, Stefan, as always, I'm very happy the guests you have on. And a quick plug in for Bill. Bill helped me buy a property, totally creative. I had to pinch myself, I don't know how many times. Did it in between military deployments. Bill, in the process, when talking to an owner, excuse me, and we find out that, well, we see the C building, we have a pretty good idea that it's got all these problems. How would you structure that into the negotiation, into the offer, kind of a timeline through? Because that's, to me, what I remember the most. It was this timeline where it was option A, B, C, and what I liked was the fact that there was very little surprises. Now, for 3 weeks, I was biting my nails, right? But there was no surprises.
Well, everybody here, I've known Nelson for many years now, and I don't exactly remember the details of that structure. So what was it, like the offering process that I had you go through? We make the first offer for yourself, the best one, and then go down?
Right.
Or are you talking about the SPY technique, which I'll cover?
Right. But if you could go through SPY, and let's say we're talking to an owner, okay. It's a C building.
Yeah.
Could you talk through how would you structure that offer, especially when this building has all this deferred maintenance that it's kind of invisible, right? Because a lot of this is so much is cosmetic that everything looks nice, and then underneath it's, oh my goodness. How would you structure that offer?
Yeah. All right. There's a lot of answers there, and I'll start on the high level and try and bring it down towards technical. First thing that I'm going to say, and I hope this isn't terribly offensive, this is ugly baby syndrome. This is what I call the ugly baby syndrome. All right. Everybody that has a child, and Nelson, I know your father, everyone that has a child out there swears their kid's the cutest kid in the world. Sure are some ugly people in this world. Somebody was wrong. Somebody somewhere did not have a cute baby. I'm just saying. All right. So now let's take that concept and apply that to what Nelson's talking about. We have a seller. They want to sell a property. Do they think their baby is cute, or do they know they have an ugly? Step one, the seller's problems and identify whether the seller understands they have a problem. If a seller does not know the property is distressed, the seller does not know why you're making some kind of creative offer, you're already out the gate on the wrong foot. So step one is research your seller. In what I mean by this ugly baby syndrome is now you are going to have to be the bearer of bad news. You're going to have to go back to the seller. By the way, and where I'm correlating this with children is every parent thinks their kid's cute. Every seller thinks their property is the greatest piece of real estate in the world, right? We've all run into that. And so that's where I'm kind of saying most of the times sellers are not completely informed as to how ugly their property really is. So step one, we got to kind of go in and sit down and explain to the seller why we are making a creative offer and why this solves some sort of problem for that seller. Now, if they don't know they have a problem, it doesn't mean they don't have a problem, but it means they don't have one because they don't acknowledge that they have it. So you've got to explain step one, hey, you guys got a problem. The seller's probably going to be like, what do you mean? Well, I want to buy your property, but see the evil bank over here, I always like that good cop, bad cop. I always blame it on the lender. I'm with you. Nelson, I'm with you. It's great property. I love you. I want to buy your property. It's wonderful. I'm on your side. It's this evil bank over here that says they won't give me a loan on a piece of junk real estate like yours. hey, they only want to give me a 60% loan to value. They're making me put up all this money for renovations and escrow. The numbers don't work. And by the way, that's not a Nelson problem. That's not a Bill problem. That's an every buyer that shows up problem. That's everyone's problem. So you can allow me to solve your problem, or you can keep letting other people attempt to solve your problem. But you have to understand, this doesn't mean I suck. It means your property sucks. You have a problem. There's how you communicate the ugly baby, right? You've got to kind of let this person know, hey, this isn't a financeable deal. Here's why. Then you come in and you follow what I call the SPY technique. All right. And this is something I created, and this is called a SPY, and it's an acronym, and it stands for seller, property, you. And that's the order in which you want to kind of solve problems when looking at a deal. Seller, property, you. Sit down and look at the property. What's going on, or excuse me, sit down and talk to the seller. What motivates the seller? What issues does the seller have? All right. Second, we look at the property and we say, what kind of problems does the property have? Is it deferred maintenance? Is it, occupancy? What's the issue? And then lastly, we look at what our problems are. This is the order in which you want to approach a seller. And this is the order in which you want to create an offer that creates value for the seller. There's the major key point of creative financing. It's not about you, it's about the seller. 90% of a good deal is seller. Only 10% is real estate, right? If you could have the best piece of real estate in the world, and if you don't have a willing seller, you got nothing. So it's really about getting the seller on board with this structure. All right. So step one, they have to understand what their problem is. Step two, you got to find out how to create an offer that solves whatever that problem that seller has. And that's why I'm saying the SPY technique. So when you're analyzing that deal, when you're trying to come up with an offer, is it seller financing? Is it a lease option? Is it a partnership? What's going on here? What's wrong with the seller? And does my offer solve their problem? What's wrong with the property? Does my offer solve that problem? And then lastly, is this a fit for me, and does it solve what I'm after? What I find is that the majority of the people that are new to creative financing go at this with, I want seller financing. I want a lease option. I want this. Who cares? Nobody cares what you want. You don't own the real estate. All right. You got to look for the seller. Don't worry about you. It's like they look at themselves, then they look at the property, and then as an afterthought, they remember there's a seller involved. There's your mistake. You got to reverse that pattern. So that's kind of what I walked Nelson through early on with some of his deals was, hey, let's look at what's the issue here. Can we create an offer that brings value to this seller? And then how do we make that offer? And I think that's where you're going to ultimately, Nelson. And then what's the process of kind of trying to make this offer? What I recommend that you do when making offers, well, let me say this. The first thing I do not recommend that you do when making an offer is make multiple offers. I see that a lot of times with people that are new to business and new to real estate. I have 3 offers. Here they are. One's a cash offer, one's seller financing, and one's, I don't know, whatever. So here are 3 offers. You choose the one that's the best. No. Horrible mistake. And that's really, really bad negotiation. You're going to create decision fatigue. A confused mind says no. What you want to do in making an offer is to submit the offer that is the best for you and solves the most problems. Submit that singular offer. If the seller says no to that offer, then you negotiate backwards from that offer, and you begrudgingly move back to the next offer or to other aspects of that offer. If you throw all 3 offers on the table at once, if you're dealing with a sophisticated negotiator, if you did that to me, the first thing I would do is say, no, none of these are good, start over. Now what you going to do? I just struck down all 3 offers and said, nah, I'm just going to throw a wrench in the I might love one of the offers. I'm going to do that just to throw you off your game because you've shown me all your cards, and I know you probably don't have any more cards to play. So that's the mistake. You want to start off with your best offer and then walk backwards from there. Never make multiple offers at one time. That's very confusing, and then you usually don't get anywhere with that one. So that's kind of the SPY technique. That's how you want to make offers. You're looking, you analyze the deal. By the way, when you're looking at deals and you're out there in the world, you do not look for creative financing deals. You don't look for them. You just look for deals. You just analyze deals the same way you always analyze deals. You talk to realtors. You don't ever call up a realtor and say, hey, do you have any seller financing deals? Do you have any, no money down? You look broke. You look like you can't close. Don't do that. Don't call up a realtor and say, hey, I'm looking for seller financing. I'm looking for lease options. You're going to get the phone hung up on you pretty quick. So just look at deals the same way you always do, just like you were going to buy them in any other manner. When you look at it and you say, gosh, these numbers don't work. Why don't the numbers work? Okay, now we got to go through the deal and we got to say, all right, well, it's either this or this or this or this, and that's why the numbers don't work. Now we start to come up with an offer that solves those problems. If you can go over to the bank and get a loan and qualify for the loan, put some money down and buy the property, you should. You only use creative financing when you need to. It is not a one size fits all, quick get rich model. That's not what creative financing is for. Creative financing is meant to increase the probability of you closing. So what I'm saying is if a fair amount of the deals you look at don't work financially and you're throwing them in the trash, I'm saying, hold on, bring them back out of the trash. Let's take one last look at them from some of the things I'm telling you now. Put on your creative hat, go through the SPY techniques, see if there's anything in here that can be solved. And what you'll find is every now and then, one of these things can be solved. And all that does is increase your probability of closing, not possibility, probability. Anything is possible. Is it probable? And that's what we have to ask ourselves. So that's why I kind of say that's the SPY technique. And that's how you need to look at deals, and kind of going through there and looking at stuff. So I'm going to shift gears and actually, Stefan, I don't mind taking a few questions. I'm not running on any kind of script here. So if before I shift gears, if anybody has any questions, you can just unmute and holler or type something into the bar. I'm over here. I'm looking at the chat. Throw it in the chat.
Well, I'm just looking at Nelson's question. Does the paradigm shift equal speculation time, you think, or?
I'm sorry. Paradigm shift equals speculation time. Rephrase that, Nelson. I don't quite understand what you're asking me. Unmute first.
Yeah, I'm trying to get to the mute button. Now, with the paradigm shift, is that like, are we going into a time of speculation where we've got such a low cap rates, almost no cash flow, and it's almost like speculation? It's like, it's like the gold rush or the tulip bulb rush, or even what we saw in 2008, where people are saying, yeah, I flipped in a property, and you're like, like the taxi driver was getting a loan for $500,000. Okay.
Do I think we are in a real estate bubble? I believe is more or less what you're asking me.
Mm-hmm.
And the answer is no. Mm-hmm. I do think we're in a syndication bubble. I do think the C space and the D space has been over syndicated, over speculated. Yes. And that people are out raising money and that they can get themselves a good acquisition fee in the beginning. And there's nothing wrong with that. I'm just saying, yes, I believe that is what is occurring, is that, and I'll be the one to say I'm guilty. Teaching real estate has brought down the barrier of entry. If we go back 30 years ago, there wasn't courses, there weren't people teaching this stuff. There wasn't Zoom meetings. It's like you had to know some kind of person to teach you how to get in the business. The barrier to entry was very high. I do believe we are actually looking at two things, a market shift and a paradigm shift. I think the market shift is coming and that returns are going to increase and opportunities are going to increase. Are they going to go back to the same returns we had 20 years ago? No. I don't think we're going back to yesterday's returns, but I don't think we're going to continue to get today's returns. I think we're going to have a decompression somewhere in the middle. I believe the paradigm shift that we are looking at is societal and global. I know when I got started, I was 28 years old. Man, when I went to a real estate seminar, I went to an event, I went to some of these people, I sat at the kids' table. There was nobody in that room 28 years old. I mean, everyone was 50, 60 years old. They're all older men. That was the demographic of real estate. Look at the screen right here. The world is not that way anymore. And so many more young people are getting into investing and getting into being intelligent and savvy with their money. And that what I am seeing is the paradigm shift we're looking at is that people under the age of 35, let's say, people that are younger than 30, 35 and younger are less consumer based. I know when I was a kid, it was always about you had to have the nice car and the big stereo, and you need to have the whatever stuff people could see and do this kind of stuff. Kids today seem to be a lot more intelligent than we were, at least a lot more financially intelligent than we are. And the interest in investing in money is greatly moved down the age category. I believe the internet's done that. I believe apps like Robinhood and E-Trade and things of that nature have all played a role in that. But what I think we are seeing now is more investment dollars in the world than there ever has been before. Because people want to make money with money way more than they ever had before. I know when I was a kid, I was just under the bleachers. I didn't care. I was looking for a date and having fun and, wanted to party. I didn't care about investing. Who cares? That's for old people. It's not the concept anymore. Investing is not for old people anymore. It's for everyone. And so I think there is a lot more money coming into the world than there ever was before. Therefore, yes, that will compress returns some, but not as compressed as they are today. And I don't think that, and that's why I'm predicting the split. I believe people are making a mistake in the C&D market by rushing in there. Pencil whipping is what I call it, when you make a deal look good on paper, but not really in reality. And you go through the deal and you kind of just make it all look good, and then you go out and you raise money and you get a fee because you did that. I think there are a lot of syndicators in the market that we need to be careful of, that are very quick to get a fee, and they're quick to take investors into assets they don't know anything about, they don't understand. And so that's where I'm kind of saying be cautious. There's nothing wrong with C&D assets at all. It's just the price. Just don't overpay for them, and so that's why I'm really cautious about that. So my opinion, and the point of today's call is to say that the creative financing is definitely going to be a wave of the future. It's definitely coming. It's definitely going to be a way to solve problems. But until it's available, let's be cautious about that asset class. Let's be cautious about older, lower rent, affordable type buildings, because they can have a lot of problems and get you into some financial trouble, especially if you're new to the business. You would be better off buying a B++, A- asset that had very little cash flow and no surprises than getting into an older building that on paper has a lot of cash flow, but then has a bunch of capital expense surprises and you don't actually cash flow. So if the cash flow is limited between the A's and the B's, if the cap rate is a narrow spread between the A's and the B's, why buy a C? Just go buy an A or a B. You're paying the same damn thing. It doesn't make any sense. If you can have an old junky car or a new one, buy the new one. Duh. That's what I keep trying to scream. And that's what I'm just telling everybody in the world. Y'all are making a mistake. Be careful about the old properties. You may not be able to underwrite those correctly. So don't overpay for those. Don't buy a 4 and a 5 cap on a 1963 apartment complex. You're going to get in trouble. You go in there and you buy that 4 or 5 cap on a 1963 property when the seller's willing to finance it for you, when you can get a lease option, when you can mitigate some of that risk by going in there and doing it. That's when we get into, the more affordable space. So for today, because we're at a peak of a market, the market is strange and it's doing things that we've never seen before. My company, and again, I'm not telling you all what to do. My company, and for my dollars, I'm moving to a safer platform of newer buildings. I think the cash flow is actually going to turn out to be about the same as something that you think is going to cash flow a lot, but really doesn't because it's older. I would recommend you don't go chasing yield. Do not go out to further and further and further and further tertiary markets because the price is lower. Right? That's what happens in there is when the market recedes, it pulls back towards its major metros, and you're going to get caught skinny dipping when the tide goes out. That's what happens when you go too far out chasing yield, too far out into those questionable markets because you're looking for cash flow and the market recedes. You're stuck out there in that market, that tertiary market, until the primary market has pricing inflated again, and we go through another market cycle. So my point here is, if you go to a small town, you go far out and you buy a lower end property, you're going to own it for a long time. You're just going to sit there for 5 to 7, 8 years, 10 years for the next market cycle, for everybody to get priced out of the major market and to finally show up over at your market and want to buy your low end property again. Yeah, but think about that. If you just bought a 1963 property and you got to hold on to it for 10 years, I guarantee you some of that plumbing is going to go out. I guarantee you you're going to be replacing roofs and subflooring and the parking lot. And where's your cash flow then? That's what I'm saying. Hey, everybody, be careful about those older buildings until we can use creative financing to mitigate some of the risk. And then it's a great thing. And that's where we use seller financing. We use lease options. We use things of that nature to go in there. Use your SPY technique, look the deal. When you analyze the property, the numbers suck and they don't work. You go back to the seller, you explain why that's the problem, why it's, it's an everybody problem. You make a creative offer, they accept it, you buy it, they don't, you move on. Stefan?
Yeah, for the benefit of the audience, do you want to go over like the different creative financing options?
Sure. I know we kind of went off on some of these other subjects. First of all, let me say I have a book out on all this. I'll talk about that in a minute. So there's a way you can get all this information. I know we're not covering all of it this evening, but yeah. So lease options. Let's start with seller financing. Seller financing is pretty straightforward. That's what that sounds like. The seller is acting as the bank. Now, for a seller to give you financing, the seller must have no mortgage. If the seller has a mortgage, they cannot technically finance that property to you because it has no mortgage, right? If they have a mortgage, you can do a lease option. Some people will do what they call a wrap, where they leave the mortgage in place and they don't tell the bank and they just make the payments. That's fine. I don't recommend that for a number of reasons. I believe that doing a lease option is a better answer. So if a seller has, a mortgage in place, we're going to do a master lease option or a lease option. They're the exact same thing. It's a lease option if it's a house. It's a master lease option if we're dealing with multiple units. That's the only difference. A master lease option in multifamily is a rent to own program, basically. So I'll use Nelson here as the example. Nelson's got a property. He wants to sell it to me for $1 million. I look at the property and I say, gosh, it's not really in good shape. I can't get a mortgage. Nelson, do you have a mortgage? Nelson says, yeah, I have a mortgage. Okay, seller financing's off the table. Nelson, I'll tell you what, let's do a master lease option. Nelson says, gosh, I never heard of that. What does that mean? Okay, it's where I am going to rent your property for a certain amount of time. And I'm also going to, we're also going to agree on a price. And so Nelson and I are going to say, okay, Bill, you can buy the property for $1 million and you can buy this property for $1 million for 3 years. All right. In that same 3-year window, I'm going to let you rent my entire property. So this is a 100-unit apartment complex that we're talking about here. Well, that's not a good example for $1 million, but forget it. So Nelson rents me this, or he lets me rent this apartment complex. The master lease. All right, let me back up real quick. A master lease option is technically 2 documents. It's the master lease and the option to purchase. Right. So the master lease is going to give me the right to rent Nelson's property with the ability to sublet to the tenants. Why would I want to rent Nelson's property? Because now I'm the management. Now I'm the owner in charge, the operator in charge, basically. So I've rented Nelson's property. Nelson was a terrible landlord. He couldn't keep the property up and running. I'm now going to take over. I'm going to straighten the property out where he couldn't. I'm going to come in and bring the operations. I'm going to come in and get the property fixed up where Nelson couldn't get it done. Okay. So now what I've done is I've forced the value above the $1 million. Nelson and I, agreed on this $1 million price. And Nelson says, hey, Bill, you and only you have the right to buy the property for 3 years at $1 million. All right. Now, because I've gone in with the master lease and I've operated the property better, the property is now worth $2 million. But I still have an agreement to buy it from Nelson for $1 million. And that is roughly a master lease option. There's a lot more details to it than that. And we'll certainly answer some questions if anybody has any. But that is it right there, is that I'm going to rent the property with the right to sublet the units. That gives me the right to go in and manage. I'm going to clean it up. I'm going to bring the value up above the option price. And once I have the option price well above or the option value, the value of the property well above the price that Nelson and I have negotiated, then I'm going to exercise my option to purchase. So it's just basically a right of refusal is what it is. And so the idea here would be to go in and find a seller that for whatever reason is a burned out landlord. That's a great one. Tired of toilets, trash, and tenants. They just don't want to deal with it anymore.
Hi.
That's a good way to do it. We have a question? No, maybe not. So that's what you want to do is find a property that is distressed but can be repaired, that's still in a pretty decent location, still in a pretty decent market, that you're looking at it, you're going, gosh, if I could just get a hold of that property, I could go in and do X, Y, and Z, and then man, that place would be worth a whole lot more.
Hello.
Lease option. That's what you're trying to do with lease option. That's how you get in and create lease options and create value with the lease option. So it allows you to to force the value above the option price, exercise the option, and purchase at that set price. So that's roughly a master lease option. Keep in mind, you're a renter. You're not the owner. You're a renter, so you're going to have the rights of a renter, not an owner. And so there are some drawbacks that come with that right there. But that's basically using master lease options, more or less. So kind of, coming towards the end of the call, anybody have any questions, thoughts, comments? Yeah, we want to talk about that. Go ahead.
My question, so would you say, let's say, some master lease options, they're used in the the residential space, like 1 to 4 unit, would you say they post the peak phase that you described in the market cycle, that they may become available in the larger multifamily as well?
Yes, I think you'll be able to use creative financing on. You have always been able to and will always be able to use creative financing on any type of property, whether it's single family, multifamily. I just deal in larger multifamily at the moment. But remember, when I got started, it was a duplex. I did my first 402 units, never walked into a bank, never qualified for a mortgage. Now, I bought 402 units through creative financing only, then refinanced at a bank. But my first 402 unit portfolio was completely either lease options, seller financing, credit cards. Don't do that.
So within that,
What's that?
Within that portfolio of 402 units, what was the largest asset, let's say, unit wise? Was it in the smaller multifamily range?
Yeah, I'll break it down for you. Yeah, I started off with a duplex. Then I did about 30 or maybe about 40 houses. And then a 9-unit was my first multifamily, like real multifamily. 9-unit, 20-unit, 27-unit, 44-unit, 152-unit, 108. And then I went into syndicating and actually, syndicating deals. So yeah, the largest being 152 unit that I actually received seller financing on 80%, and we put down 20%. So I actually did a syndication with seller financing. So I combined all of those pieces there. The one before that, 108 unit, was the largest master lease option that I ever did. I did do a lease option.
Well, let's say in that scenario, so you have like a syndication and you're putting 20% down seller financing. Now, what is the benefit compared to the sponsor compared to doing an agency loan in that case? Because with the master lease option, it's a pretty clear benefit. That's that's great. You have the right of refusal, etc. But with seller financing, it's sort of an equivalent. It's more if you can raise the loan to value, raise the leverage, or get better terms on the lending.
Right. So seller financing is about giving on price and taking on terms. So you may wind up having to give this seller something close to what it is that they're asking for in price. Fine. But you want to structure the mortgage very heavily in your favor. Maybe that's very little money down. Maybe you don't have a lot of cash, maybe it's interest only, maybe it's a very low interest rate. So, don't be as sensitive about the price, be sensitive about the terms, and be sensitive about the actual value of the property. And remember, price and value have nothing to do with each other. Right? Price, everybody always worried about price. Who cares about the price? Be worried about what that property will be worth once you've exercised your business model. That's how we look at deals. So, focus on the terms, focus on making that property work for you under the seller financing. One of my favorite things to do is to trade renovation money for down payment. right? So if I go in and look at a property and I see Nelson wants to sell me this property and it needs, and he wants to do seller financing and he wants 20% down, and that's $100,000, let's just say, and or let's say $200,000 for his $1 million property. He wants $200,000, excuse me, down, and he'll seller finance the $800,000 that's remaining. And I look at the property and I go, gosh, but Nelson, you have $100,000 worth of work that needs to be done to the property. What I'm going to try and do is give Nelson $100,000, take the other $100,000 down payment and put it into his property to renovate his property with that money. And so I'm going to go to Nelson and say, look, you want $200,000 down. I don't want to put down $200,000 and then have to come up with a whole nother $100,000 to fix your property that you let go. That's $300,000 out of my pocket. I don't want to do that. I don't mind having some skin in the game. I don't mind being committed to the deal. You need to know I'm serious and I'm not, playing games. Fine. But I'm only going to give you $100,000. The other $100,000, I'm going to put in escrow with our attorney. And I'm going to use that escrow money to fix your property up. You can watch, you can see the repairs, you can see the money in escrow. You can see the draws as I'm going along, but that's what I'm going to do. So I'm going to try and put that money in escrow and then use that for down payment money, going forward. So this is just one of the techniques that I like to try and do using seller financing. Any other questions? Again, I have a book out on all this. It's called Creative Cash. You can get the book on Amazon. You can find me at creativeapartmentdeals.com as well. I have a masterclass there. So $15 and you can get a book that I guarantee you will give you skills and tools to increase your closings over the next several years. Yep. So that's, yeah.
I mean, the second technique still to come back to the smaller versus larger multifamily master lease options. Is that something you have seen? You have done like 50, 100 units? Yeah.
Yeah. Like I said, I've done seller financing, my very first deal of a duplex.
Yeah.
And got a master lease option on 108 units and seller financing on 152. So it's irrelevant the size, it's irrelevant the type of property.
The market then, like primary, secondary market, tertiary? No?
Makes no difference.
Makes no difference.
It's all about the seller. Do they have a problem? Can you create an offer that creates value to that seller? If the answer is yes, you can do this in houses, hotels, strip malls, big markets, small markets, short, tall, it doesn't matter. It's all about the seller. You can use this on using cars. You can use these techniques to, I don't know, for your children. I've had people come back and go, oh, I use some of those negotiating techniques on my children. I'm like, oh God, please don't do that. But, so point being is that you can use these techniques for all sorts of things. It doesn't have to be strictly one type of property or one type of property.
Say we have a 100-unit building in the primary market. So we are, I don't know, in Florida somewhere, like by Miami, let's say, or where Nelson is, for example, let's say. So that's like the extreme example. So it's highly competitive, and you go to a specific seller, and he's given property. So under your SPY technique, let's say, what could work under this scenario? So you have a primary market, you have a pretty big asset. To your point, it's not relevant the asset size like this, but what could work to incentivize a seller to give you a master lease option or seller financing, unless he's in some way challenged to do his sale, unless he's kind of having difficulty to sell,
Yeah, they won't. There's no option.
There's no option.
No. If a seller doesn't have a problem, you're very unlikely to get creative financing. And that's my point about looking at the expansion of the market. If we looked over the last 5 years, the market's been so hot that when a problem showed up for a seller, they just sell it. It's when debt pulls out. That's when.
Let's say, so in the primary market, so the market is certainly not a problem to the seller. It's a booming market. There is a lot of demand, etc. The property could be a problem.
Correct.
Maybe they don't want to maybe buyers don't want to deal with that specific kind of issue that it has. You have a solution to that, you come in. Let's say, is that going to be the typical scenario there in primary markets, or?
Again, it's not going to have much to do with the market. It's going to have to do with the seller. Does the seller have less problems because they're in a hot primary market? They could, yeah. And then that may make seller financing or financing in that regard a little bit tougher. yes, in a hot market, you're in the middle of downtown. I'm in Atlanta. You're in the middle of downtown Atlanta. Yeah, that's going to be tough because that real estate's just gold. Doesn't matter what the market cycle is. So yes, in a very, very core market, it's going to be tougher than in a tertiary market. Yes, I agree. But here's another thing. Why would a seller who has good real estate and no real problems want to do seller financing? Taxes. They may not want to take a big giant capital gains hit. And that's a great sales pitch to a seller is, look, I can show you how to transfer that property, continue to make revenue, continue to bring your profit in small chunks and not lose a whole giant portion of it to the government in taxes. Seller financing. So remember, in seller financing, a seller is only going to pay taxes on the interest or the profit from that loan. So using these techniques is a great way to even help a seller, who may not even understand they have a problem. Taxes. So it's a great pitch. I've actually done several deals where a seller just said, hey, look, I just don't want to pay a bunch in taxes. And I said, great, finance it.
So what would be some like really amazing seller financing terms that you have seen that, that you want to, let's say, mention? So for example, let's say what would be in terms of down payment or interest, etc. Now, trading renovation money, that was an excellent example. But in terms of more like the typical lending terms,
gonna be close to market rate or a little higher. So if you're talking about interest rate, it's probably going to be at the market or maybe a little bit higher. So today I would say expect 5-6%, maybe an interest rate, something like that.
Right, because that's what I've seen with, at least like with with marketed seller financing. Now that's not what you are after, to your point, because you wanna kind of approach the seller financing you to initiate it, right? That's the more
right. Yeah, typically.
But with marketed seller financing, what I've typically seen is higher interest rates. I feel maybe they're inflating the price a little bit because they kind of are giving this option. So this kind of thing. But
low down payment.
So if interest rate is same or a little higher, then why do you want it? Like in that case, like why do you want to get a 15% down? That
low down payment. Yeah, maybe 5% down, something like that.
So,
So maybe. So again, I would not want to get that kind of high leverage from a traditional lender who could actually foreclose. With seller financing, I'm a lot more comfortable about being over leveraged because it was never my asset to begin with. So it's not as big of a problem. If you don't perform, the seller just take the property back, but it's not going to be a foreclosure that goes out there on your financial record. So that's why I'm a little more lenient with seller financing than say, that same kind of debt structure coming from, say, a bank or Freddie or Fannie. I wouldn't want to over leverage with those, but I could with those. Yeah, Nelson, what you got?
Bill, in what you're talking about in this paradigm, and I'm going to put my fingers like the graph, right? Like you said, do you see, I know you see opportunities for C&D product going out. And let's just say it's good C&D product, because there's some that's unfortunately going to be, we don't want to see that anymore, what happened in Miami. Do you see opportunities for B product going on in the future?
Yeah, again, less so for creative financing, less in the A's and the B's, yes. But again, if you look back at the seller, could a seller have a motivational issue and own an A or B product? Yeah, absolutely. Could a seller have some kind of family issue and need to get out? Could a seller be just tired of dealing with tenants in an A asset? Yeah, it could. Less likely, being clear, less likely. But yes, you can do these in any asset class. Again, it's, can you create value for that seller? Why would they do it? Why you? Why would they do that? So we typically see more problems in the lower assets than the higher ones. But yeah, you could do it across any asset class.
So this would be also good to, this is kind of just talking here, where I would be coming into the seller, let's say it's a C, D, forget about it. It's a seller. This is my sponsor. This is my property management company. This is our portfolio. This is where we've done this. We have a track record.
Right.
So that would give that seller that peace of mind.
Yes.
And in your kind of property, this is our track record.
Yeah.
And that's how I see the offer always to be structured.
Yeah.
You know, this is who we are. This is what I bring to the table. This is our track record, and this is the kind of property you have.
Credibility.
Mm-hmm.
Great. Yeah, absolutely. Again, like I said, go out and just look at deals. Don't go out and look for seller financing. Don't go out and look for match lease options or any of this kind of stuff. Just look at deals. And by the way, everybody here, you should be looking at 3 to 5 deals every single week. 3 to 5 deals a week, every week. Whatever it is you're trying to buy, whether it's houses or duplexes or large apartment complexes, you need to be analyzing 3 to 5 deals every single week. And if you'll do that, the ones that fall outside of the parameters of working from your financial perspective, those are the ones you go back and take a look at through this creative lens and see if there's a way that you might solve a problem in there when they don't work for traditional financing.
So another question, I'm not sure.
Okay. Do we have any other questions?
Okay, so I had a question actually. So in terms of the age of housing, the WOW cap rates at the C and D costs, right? So you're seeing a split there. Now, when we split sort of US housing in this way, then we're going to see sort of different geographic regions come in at a higher risk, right? So would you say that, so what are those? So would it be like Midwest, Northeast, etc., having like more of the older housing, like what do you see on your end?
I mean, there's older housing all over the country. Yeah, I mean, if you want older housing, start with Detroit. I think the problem will be hyperinflated in areas that are having low or no population growth. That's the areas you're gonna wind up in. The biggest issue is markets, cities, or states that are currently having population decline or population leveling off with aging buildings. That's where you're gonna be careful. You always want to be careful about buying in a place that's losing population, regardless of what you're buying. A, B, C, D, it doesn't matter. So those are the areas that I think are going to have the biggest. Yep.
Right, but only if you overpay, or if you pay the right price but still have a hit. Like,
I mean, you pay the right price is always the right answer. Right? There's never a time when you should overpay, but even if you pay the right price today and people continue to leave the market, your rents will go down. And then you may have operational trouble going forward. That's all I'm saying there, is that you may have rent decline and operational trouble. Now, if you overpay, expecting to grow rents and the population is declining, yeah, you're baking in a whole lot of mistakes altogether. I think Matilda had something she wanted to ask there. Go ahead.
Hello, Bill. How are you?
I'm well.
Thank you, Nelson. Nelson invited us for this Zoom, and thank you, Nelson. We have a question. We have 3 properties in San Diego right now, rental properties for students. But we're tired of the business, and we have like someone, but our previous manager that is bothering us, and like long story. We want to sell it. Do you think right now it's a good time to sell? 2 of these houses is under the trust, and it's a irrevocable trust. Do you think it will be complicated for tax issues? And
I'm not sure on the irrevocable trust. I've never done one of those. I don't know how that works as a sale. If anybody else has done a trust here, maybe they can answer that one. I don't think it's going to be a problem selling out of the trust. I think it's a problem getting financing or buying when you want to put something in a trust. That's my understanding. Is it the right time to sell? There's never been a better time to sell. Do
you think if we wait another month, it might be like 2-3% more?
Or 2 or 3% less? When is the I can tell you exactly how we all know the day the market peaks, the exact day, hour, and minute. You know how? We look backwards and go, oh, there it goes.
So true, yes.
That's how you know. You don't. All you can do is keep gambling until you're wrong. I would suggest that you decide on a higher and better use for the money. So if you're going to make money from selling these properties and stick it in a checking account, I would recommend you keep the real estate. It's better than leaving it in a checking account. If you can take this money and redeploy it into another investment that's equal or greater value or greater return, then you make the move. But to answer your direct question, is today a good time to sell? It's the best time ever. Prices are just off the chart. So yeah, I would say if these assets are a problem, if they're dragging you down in some manner, if they're an issue, great time to sell. But don't sell just for the heck of it, because then you take this cash, which we know loses value through deflation or inflation, excuse me, every day. You don't want to just put it under the mattress, you know. So you want to have a higher and better use. That's my
You mentioned we're not in a bubble, right? Broadly speaking, other than the C&D discussion. So let's
I think we're in a syndication bubble, but yeah, all in all, no.
We have like San Diego, kind of like a primary market, you know, that is very favorable. Not in a bubble, supposedly.
Some areas could be closer to a bubble than other areas. Yeah.
Prospects of inflation, maybe, you know, benefit further from that.
If we're not in a bubble, this will do until one gets here. I'll tell you that. Which I don't think we're in a bubble, but I think we're headed for it.
And one last question, and sorry, we're done. We want to see if we don't, these properties are cash. We don't have any loans into it. Do you think we should take a loan and then sell it? That will be more beneficial to us, so we can use the extra money in some other areas, or no?
It in theory would dodge taxes. Borrowing money is a non-taxable event. Making profit is a taxable event. So if you borrow all the profit out of the property, that's non-taxable, and then you turn around and sell it and you pay the mortgage off, and I'm not giving you legal or tax advice here, but you would probably mitigate paying a whole lot of taxes. I would be concerned with any sort of prepayment penalty that might come along with that mortgage and stop you from selling it. A lot of time lenders don't want you to borrow money for a week and then give it back to them. Now, they're not in the business of doing that, you know what I mean? So number one, they may put some kind of prepayment penalty in there that would then change the narrative there. Number one. Number two, fees. Be careful. Are you how much of your profit are you giving up in fees to the bank during the period? They charge fees. It's not free. So you kind of got to weigh up the profits, taxes versus fees. But those are my short-term answer to that.
Thank you, Ben.
Sure.
Great. If you guys have other questions, feel free to speak up.
And I'll give you everybody my email address here. I'll tell you what, I'll type it in the message here so everybody can have my email. And you guys have questions in the future, feel free to reach out to me, anytime. Let's see, it's Bill at Go Broadwell. I typed out broadwell.com. Bill at gobroadwell.com. Wait, no, I'm just typing that in direct. Oops, sorry, hold on, copy. How do I stop that? Seem to be doing some kind of direct message. Why am I doing that? No, I don't do the direct message. How do you do to everyone?
You just select everyone. I can, let me see. I'm not sure if I can get your email perhaps and paste it one moment. Yeah.
Oh, everyone, I changed it. I got it now. Okay, there we go. I figured out the wrong button. There we go. Bill at Go Broadwell. There you go. There's my email. And Broadwell Property Group. So yeah, if you guys want to invest with us or you want any information on doing business with me, feel free to go to Broadwell Property Group, and we have an investor section. You can fill that out and we'll be in touch with you shortly. If you want to learn more creative financing, get the book, Creative Cash. It's on Amazon. You can also just do a search, and not, this always sounds arrogant when I say it, but if you do a search for Bill Ham Real Estate, you'll pull up about 30 different podcasts and different things that I've put out there as far as information, other materials. So I got a ton of stuff out there. You guys can all go get for free and learn. I know there's no way we can shove all this information into an hour and a half call, but yeah, hey, send me an email. Love to answer questions. Get the book. You can follow me on Instagram, Bill Ham _real estate. I'll type that in here as well. We put out content on there pretty regularly as well. So give me a follow and we'll get you caught up. Let's see, Bill Ham Real Estate. There you go. That's the Instagram account there. Yeah, but hey, I appreciate you having me on, Stefan, and I'm gonna go get some dinner. It's getting late.
Yeah, that was great. Thanks, Bill,
Sure,
for giving the time and doing such a valuable lecture to everyone. Really appreciate it.
All right, yeah, and good to see everybody here. Nelson, everybody else, thanks for having me. You guys take care.
Yeah,
Thanks, Bill. Good to see you.
Thank you.
Bye bye.
Yeah, take care, man.
Nelson, do you have a podcast with him?
Yes,
We-
as a matter of fact, I did too.
because we follow Nelson's podcast. It's
Okay,
great.
yeah, Nelson, I don't know if you've released it or you haven't, or yep, but I'm on with Nelson. Yep, for sure.
Well, then we are going to be your fan too.
Excellent. Thank you. I appreciate it. Look forward to talking to everybody. All right, take care. Bye.
Bye-bye.
Bye-bye.